because the reality is in a search, you're searching for 2 years. So 730 days, and 129 of your days will be failures, right? Only that one day
Right.
you acquire will you have success. And so that's a terrible way to go through life, and it will make you miserable.
True.
And so you have to find other ways to measure your success.
Welcome to Carry On with AJ, where serious capital meets honest conversation. Each episode, we sit down with investors and operators to unpack the decisions behind long-term success. Welcome to today's episode. Let's jump in.
Hi, Matt. Welcome to the show.
Thank you, Austin. Good to be here.
Awesome. So in your own words, can you tell us about your background and your firm?
So by background, I started out as a computer programmer and then went to business school for the big pivot. Ultimately shifted into consulting and thereafter into this world of search funds. And so this is in 2008-ish, and I've been in and around this world of search funds since then. And so that's what we do now. Our firm is an investment group, and we invest in entrepreneurs who go out and look for interesting companies to buy, typically $2 to $4 million in EBITDA. We help those entrepreneurs buy those companies, and then we help them operate them subsequently.
So I learned a little bit about your background. You worked in consulting, tech, private equity, family office, the whole spectrum. So what was the moment that you realized buying and operating small businesses is actually the most interesting place to be?
Yeah, it probably happened somewhere in the 2007, 2008 time period. I was actually introduced to the notion at school by my current business partner, Mark Sinatra. And so we were actually interning at what was called the Small Business Development Center at Wharton at the time. And my intent at that time was to ultimately start something from scratch. I wanted to be the big VC entrepreneur. He told me about this notion of search funds, explained it to me. I said, Mark, you're crazy. Who's going to give me, a former computer programmer, money to go buy somebody's business? That's nuts. And I ended up not really having the idea for what I wanted to start at that time. So I went off into consulting. Meanwhile, Mark launched his own search fund in 2006 with a different business partner. And over those 2 years, he and I were friends, and I got to follow him through his journey. And what I realized is that because I didn't have the idea and wasn't really confident in going and starting something from scratch, buying something that was already operating was really a great way to potentially earn equity in a business. And so it was really, that 2007, 2008 period, watching him go through that process.
So was he successful? Like, was that a good journey that you think, like, I wish I could have done it?
Yeah, so his search journey was absolutely successful, but definitely had its bumps along the way, which is not terribly atypical of these types of endeavors. Definitely a big bump, a big hurdle with the financial crisis of 2008.
Right. Right. That's a tough environment. So I think it really takes a special lens, which I believe you have, to identify those people. So what is exactly are you looking for? Like, how do you find good people on a good deal?
Yeah, so two separate questions, and of course they're very related. We do a lot of work to find the entrepreneurs who we want to partner with, and oftentimes the work starts years before we invest with an individual or a partnered search team. There's one searcher who we've invested with who we had known 20 years prior to investing. And then when conversations turn serious about potentially investing in an entrepreneur at the search phase, we then go into a lot of detail around their specific plans for their search and how they're going to go about identifying a business opportunity. And then, of course, we invest a small bit of money with them at that point in time to help fund their search. And then we get like a 2-year inexpensive interview with the person, right? As they're looking for businesses to buy. And so we get to assess the businesses with them side by side. And so we go into a tremendous amount of detail in our diligence. And so we've got 2 to 4 years worth of time working with them.
Got it. So let me summarize my understanding, and you can tell me if it's correct, is let's say they come to you asking for financing to do the search, typically 2 years. And this financing typically covers the diligence cost and their own salary. Is that right?
Exactly. And we're funding their search. So that pays the salary. Of course, it helps fund their diligence as well as once they have something under LOI,
Hmm.
but it does not obligate us to participate with the searchers. But we as investors have an option to participate with them at the time of acquisition. If we like the opportunity, we will write a larger check to help the entrepreneur with the equity side of the capital stack.
And how does this compare to a traditional private equity model?
It's similar in some ways, different in others. With a PE shop, and caveat, I've never worked in a traditional private equity shop. Yeah, you've got an office and you've got a group of analysts who are sitting in cubes. In our world, we partner with entrepreneurs who are scattered across the country. So we might be working with 20 entrepreneurs, and each of those entrepreneurs are looking for their own company to buy. And so we've got this group of, like a private equity firm would have analysts, we have these searchers scattered around the country. We work with them individually. When those searchers buy a company, they then become the operator of that business. So they parachute in as the CEO, which is different than a private equity shop that might keep the existing CEO in place. Essentially, they have one company portfolio that they manage directly in the trenches every single day.
Interesting. Yeah. So there's a narrative about millions of business owners held or owned or founded by boomers. They're about to retire and they wanted to come to the market and sell that business because their children wouldn't want to inherit that. Is that still the thesis? Has that play out? How much market capacity is there?
Yeah, everybody talks about how much wealth is transferring, how many small businesses that are out there. You'll see stats like there are 5 or 6 million SMBs. We know that there are millions of these companies, but how many of them fit the criteria? We don't know exactly. I think the stats say there are about 1 million companies that are viable candidates
Uh-huh.
for sale. How many of those fit your criteria? Criteria being lots of recurring revenues, $2 to $4 million EBITDA, B2B services. And so it's something south of 1 million, but something
Hmm.
most likely larger than the number of searchers who are out in the marketplace looking for something. So we still think it's a fertile hunting ground for our searchers. And our searchers still are uncovering opportunities, in many cases proprietarily, that they can act upon.
Got it. You actually have an amazing track record when I was doing the research, right? You've been investing since 2000, like a little bit post the crisis, and your portfolio returned 38% IRR, which is 4.8 times well capital invested, right? But I would love to understand, how did you do it? Do you think it's a sustainable trend or number that you can do it, or it was influenced by specific factors?
Yeah, that's also a very fair question. There's always luck involved, right? And the time frame for that track record is largely through the 20 teens, right? And so you're going through a very uh, bullish market with
Right.
a lot of tide, a lot of wind behind you. And so, yeah, it was a great portfolio. There's definitely timing luck. I do think we had a really great group of entrepreneurs who we worked with. We could have like 4 partnered search teams. We found really interesting companies that were just on the cusp of a lot of growth. And so we bought in at the right time with the right people. Is that sustainable? I think there are arguments on both sides. Stanford puts out these reports
Yep.
biannually, and historically, the asset class returns north of 35% annualized. So yes, we beat the average. Did we crush the average? No, we beat it. There's been an explosion in popularity in the model
Yeah.
over the last few years. There are more searchers than ever, and I think it stands to reason that the more focus there is on an asset class that's generating outsized returns, and the more money that gets deployed to it, the more likely it is that returns revert to something more normalized. So
Hmm.
it's logical that results and returns could compress. We're still in our first cycle with ETA equity.
Hmm.
Our first investments were made in the 2021. We're optimistic about where things are headed.
Got it. So that means like your typical font structure is over 10 years, right? It's 10 to 15 years.
It's akin to a private equity fund. You have to leave a couple of years for searchers to search and look for a business.
Yeah.
Generally expect them to operate for 4 to 7 years. Our fund is structured a little bit differently. We raise smaller pools of capital on a more frequent basis. So basically, we have an annual
Mm,
vintage of a fund. That cuts the life expectancy of our funds down to like 7 or 8 years. But generally speaking, yes, a fund life cycle would be 8 to 10 years.
that makes sense. And you briefly mentioned there's single searcher or a group of searcher. Do you have a preference?
Yeah, we absolutely have a preference. The guidance that we give the searcher or searchers is that you have to do what works best for you, because even though we have a preference for partnered search teams, not everybody is best suited to work as part of a partnered search team. Our data has indicated that our partnered search teams acquire at a much higher rate than our solo searchers. The Stanford reports will show that the partnered searches generally outperform the solo searchers on an IRR returns basis. There are a number of reasons for it. To your point, searching is an incredibly lonely process. Having somebody there to help you through the ups and downs is incredibly helpful.
Hmm.
In a partner search, we fundamentally believe that they end up covering more than twice as much ground as a solo searcher, and so you get that benefit as a both a search team and as an investor.
Okay, that makes sense. Say I wanted to raise a search fund. What are you looking for?
It's evolved a little bit over time. One is people who search now have to be extremely well prepared. It's a lot different than it was, say, 15 years ago when the model was a lot less known. These days, people are going back to business school to get their MBAs specifically so that they can go and search. It's pretty
Wow.
wild compared
Yeah.
to what it used to be like. But you have to find people who absolutely have done their homework. Talk with dozens, if not hundreds, of former searchers, current searchers, investors, operators, people who have interned with all of the above. Yeah. And
Mm.
then you have this other group of people that have also had success over time, these what we call mid-career professionals, people who are currently working jobs who want to transition into search. But how difficult is that to do on the side while you're working a full-time job? It's incredibly difficult.
Yeah.
So we definitely look for people who know what they're getting into, searchers who have conviction around where and how they're going to go about looking. So they need to have theses around the industries where they're going to focus,
Hmm.
theses around how they would grow those businesses once they acquire them. Right or wrong answer. There are a lot of different ways to go about a search, but it needs to be a very logical progression that they can explain very, very clearly to us. And they have to very clearly be able to articulate the KPIs that they're going to follow over time to ensure their success. Because the reality is, in a search, you're searching for 2 years. So 730 days, and 129 of your days will be failures, right? Only that one day
Right.
you acquire will you have success. And so that's a terrible way to go through life, and it will make you miserable.
True.
And so you have to find other ways to measure your success. And so we really focus a lot on making sure that the prospective searchers understand how they're going to track the daily actions that drive success, and understand what those daily actions are that ultimately will drive the success.
Can you put more numbers on it? What are the metrics like a number of phone calls, number of outreaches, like, and what is a reasonable range?
Yeah, I think it depends somewhat on the approach. When we searched, everything was very proprietary, very manual. My business partner Mark did a lot of cold calling, and so he would write a number on his board. Hey, I need to make this
Uh-huh.
many cold calls today. I had a very different approach. I wasn't good on the phone. I would show up at conferences and try to have as many in-person, one-on-one conversations with business owners as possible.
Right.
Ultimately, one of the most important drivers is quality conversations with business owners. That's a real key indicator that you want to get down to. In an ideal world, you're having one good business owner conversation per day. It's probably somewhat south of that. I don't know that that's necessarily realistic. And then you have to work backwards from there, depending on your approach, to see how many you need to get into the top of that funnel.
What would be the ratio? Like, what's the typical conversion rate?
I think most searchers are aiming to have at least 1 to 2 signed LOIs per quarter. You probably need to have a good 100 conversations plus with business owners to get to one LOI, because So many will just fall out of the funnel after the first conversation. There's so many variables that can disqualify an opportunity. And so that's another key skill that these searchers have to have. They have to be able to disqualify these opportunities very, very quickly to move through them.
Right, right. But where do you see most people pin as this is the biggest value driver after acquiring?
In many cases, it's really basic, simple stuff. Um, in almost all of the companies we acquire, there's almost zero formal structure around outbound sales and marketing. I mean, it's
Uh-huh.
amazing to believe, but you've got these $2 to $4 million businesses without a lot of structure. Also on the revenue side of the equation, generally they're offering one or two basic services, so there's opportunity over time, of course, after you get to know the business and you make sure to
Mm-hmm.
add on other offerings as you go. Depending on the industry, oftentimes there's also the ability to expand geographically. So it's really basic blocking and tackling on the revenue growth side. A lot of the opportunity in these companies is search funds have generated a lot of value over the years, and AJ Wasserstein at Yale has done research on this, is that they gain multiple expansion upon sales, many times
Oh,
to private equity. And private equity is looking for more streamlined internal operations. So, regular financial reporting on an accrual basis, standardized hiring and firing procedures. Those are the sorts of things that you streamline operationally in preparation to pass the business on to somebody else down the road.
right. And do you think the aggregator play still works, or they're like roll up similar businesses in different regions or just neighborhoods?
There are searchers who execute more of a roll up strategy. I would say that's the minority of folks that we work with.
Hmm.
Um, we operate in sort of this traditional Stanford search fund model ecosystem. There are emerging models that are more conducive to doing roll-ups and add-ons. What you will see very often in the traditional search fund model is as you get the engine running very smoothly over time, starting to do more add-on acquisitions that are very accretive economically.
Right. Yeah. It's like, how do you finance that? Like, how much is equity? How much does the entrepreneur have to put their own money in, and do they borrow debt?
Yeah. Again, it depends on which flavor of searcher. And the traditional model, of course, each searcher has usually 8 to 15 investors on their cap tables.
Mm,
These 8 to 15 investors will typically provide the equity, and the equity typically makes up 50 to 70% of the capital going into a deal. Now, 50 to 70% is equity. The other 30 to 50% is usually some form of debt. Ideally, you want to have some senior debt from a bank. Oftentimes, you have some sort of seller financing as well. In certain
mhm.
circumstances, you might have private credit as well. But in the traditional model, the searchers typically are not putting their own dollars in, but oftentimes these are recent MBAs who don't have cash to put into the deal. They're working here primarily for the upside of earning equity down the road.
I see. So it's actually higher equity proportion than I initially thought.
I believe earlier in the search fund history timeline, there were much more highly levered buyouts. Today, what we're seeing is the more highly levered buyouts are happening in the self-funded search realm, but they're getting the vast majority of the money for the acquisition from a lending source like the SBA funded bank and taking
Right.
on a personal guarantee.
What's the reason that we don't have such high leverage?
It's a little bit of both. The search fund ecosystem, the model allows for generating the kinds of returns that we've generated without taking on that much leverage, which is fantastic. Also, it always puts a strain on growth. The fewer obligations you have, the easier it is to start reinvesting in growth. And this model is primarily focused on reinvesting cash flows back into the business to grow top line.
Got it. And you mentioned 8 to 15 investors. How many of these investors are professional investors just like you?
Yeah, it's interesting. I'd even describe a lot of the individuals who participate as professional investors now, just because they're such smart, sophisticated people, most of whom who've done some flavor of this type of work historically. There are probably 10 to 15 funds like ours around that invest solely with LP capital, so capital raised from outside investors. There are quite a few family offices who have been doing this for a long time, and
Yeah.
then there are a lot of individuals who do it as well. A lot of those now, especially since the model's been around for 40 years, are people who have had their own searches, operated businesses, exited successfully, like the model so much that they're reinvesting back into it. So, in total, there are probably 100 investors who that searchers can go out and raise money from.
And is there's a typical lead investor, or is pretty even?
Some searchers gravitate towards having some leads. Some searchers gravitate towards having a more diversified cap table that's very evenly spread. We're a relatively smaller fund in the ecosystem, so we typically only lead when we absolutely fall in love with a deal, and when a 10% investor can be a lead investor. But oftentimes in these deals, there are certain investors who might take 20% of the cap table during the search and upwards of 20 to 30% of the equity at the time of the deal. Usually there are not more than 1 to 3 of those lead investors in an opportunity. There have been some larger search fund deals at $8 to $12 million of EBITDA that require multiple larger investors to come in.
Yeah. And what does the investors do after you actually acquire the business? Are you pretty hands-on operating?
It depends what you mean by hands-on we don't get into the day-to-day operating unless something's gone terribly wrong.
Yeah.
We're there to support the entrepreneur. So it's mentorship, it's guidance, it's making introductions to experts in either the industries where they are playing. Some subset of the investors in each search fund and search deal end up sitting on the board. Board involvement can vary depending on the circumstances. When
Yeah.
things go wrong, the board gets very, very involved. And sometimes that requires stepping in day to day, shoulder to shoulder with the CEO to help operate the business.
Got it. Have you seen after the acquisition, the business has actually worsened and they lost customers because, I used to deal with Joe. Joe is no longer with the firm. And now you two young guys, I don't want to talk to you guys.
Unfortunately, it happens. We'd like to believe we do all the diligence and never miss anything. The reality is, even when you have 10 smart people doing diligence on an opportunity, sometimes things are missed, and sometimes things just turn against you. You don't know if a payer, like in a healthcare opportunity, is going to cut reimbursement rates, and so yeah, it definitely happens. I'd say our historical performance in the ETA equity is sort of mirrored that of the Stanford research. So Stanford does a really nice job aggregating the cumulative statistics of the search fund ecosystem. And their stats point to like 65% of acquisitions ending up with positive returns and 35% ending up with negative returns. And
Hmm.
then only of those negative ones, only a small portion of those end up going truly to zero. Uh, and the way I think about that is the distribution of results is somewhere between the risk profile of venture capital and traditional private equity. Less risky than venture, perhaps a bit riskier than traditional private equity because the companies are smaller. But on a risk adjusted basis, you can see that the IRRs indicate that it's well worth the risk that you're taking.
It's actually pretty good data. If I know that I have two-thirds of odds winning, because over the long period of time, over many bets, I'm almost guaranteed to win, which is not a bad business.
Yeah, conceptually, it makes all the sense in the world. There's one investor that I've known for a very long time. His saying is something to the effect of, you can only lose your money once in any deal, but you can make your money many times over on each one. And
Yeah, that makes sense. And I just wanted now to get your hot take. What are the good businesses that like? What are the kind of good categories that you like? And you mentioned kind of recurring is one of the attributes. What else?
yeah, it's interesting also that 20 years ago, I would say that most investors looked at one kind of business.
Uh-huh.
Easy to run, a lot of recurring revenues, high cash flows, low capital intensity. That's where most people want to play. That being said, as the investor universe has expanded, so too have tastes and preferences. We've seen, though, some investors gravitate towards software businesses, towards very blue collar industrial services. They're all looking for extremely high quality revenue, so as much recurring as possible, high margins, high capital efficiency, low capex, low customer concentration, critical services that are vital to the customers. But it's a spectrum. I'm a software programmer by trade originally. I would love to do more software deals. Software over the last few years has been really expensive, so we've been very careful. We've been doing a lot of blue collar services businesses. And now, especially over the last 6 months, there are massive questions around which business models are more resistant to this AI revolution.
Right.
We're trying to work our way through it logically and trying to pick those companies that we think are more resistant.
You mentioned Stanford published the data. I know that HBS also has a club. Where else should people learn more about it?
Yeah. So Stanford puts out great research. Definitely go to their website. I would advise going to ETA conferences or search fund conferences. There are a lot of universities that have them now. Start looking around at investors' websites to see what their portfolios look like. Start contacting those to do introductory conversations. Start contacting the searchers and the operators that are in their portfolios, and do primary research. Have intro calls with those participants in the space.
Interesting. Yeah. So it sounds like it's a very friendly environment. The searchers are not competitors, even though they're all searching in the market.
They are and they're not. It's a very collaborative ecosystem. Absolutely. All of the investors to some extent compete to get into search funds in their deals. But once they're in, they're collaborators. So it's friendly competition. Same with the searchers. They may end up trying to buy the same company from the same owner, perhaps in a process. But as they go through their process, they need a shoulder to cry on. They need somebody to compare notes with to see how they're progressing. So it's definitely, we call it competitive collaboration.
Yeah, sounds great. We have audience who successfully built a business and sold it, so they're sitting on liquidity. If they are thinking about, okay, this is an interesting business model, I can either do it myself or, throw money to one of the funds that you run and say this is simple enough for me to be relatively passive. Can you help me think about the framework? How should they think about the liquidity being put to work?
Yeah, and I'd say that the answer probably differs now from what it did 10 to 15, 20 years ago, when there were far fewer investors. I mean, the space has definitely attracted a lot of attention. And so if you're an entrepreneur or a former operator sitting on cash and would like to get into the space, you really have the option of trying to do it directly, but it's time intensive. And so the first question you'd ask is like, how much time do I have to participate? And how much effort do I want to put into doing it? You have to develop a reputation for being
Right.
helpful and having the capital available, or you can invest in somebody who's already doing that. Even if you did that, there are opportunities to be involved. And we call on our LP base all the time to help with diligence, particularly if they're an expert in the space. Most of our investors are either former entrepreneurs or professionals who have liquidity. They fundamentally believe in investing in small businesses, but they don't have the time to go out. If that's you, that's when you want to go more of the fund route.
Great. Yeah. Getting specialized and getting the deal flow is actually pretty time consuming. And I know that you actually coach high school basketball for a long time. Right. So
I have. Yes.
tell me, is it easier to coach high school kids or is it easier to coach the operators?
Which is easier? It probably depends on the day that you ask me. They're absolutely challenges to both. They're very different challenges. The commonality between them, it's all about the team, right? If you have an operator who's building the team the right way, is focused on empowering people, rewarding people, you're going to end up in a good place. Which is more difficult? I'd say they're equally difficult in very different ways.
Yeah. Where can people find you if they wanted to talk more?
Yeah, absolutely. People can find me easily. Their website, etaequity.com. You can email me at matt, M-A-T-T, at etaequity.com. You can find me on LinkedIn as well.
I really appreciate the insights. This is a space that a lot of people are interested, but they don't have the information to get started or get serious about it. I think you provided a really good foundation for them. And thank you for being accessible. So, yeah, I really appreciate your time.
Yeah, thank you so much, Austin. Great to be here.